Hey guys, it's Friday the 12th, and we are starting to enter just such a strange period in the markets. And I got to tell you, I always feel this way between earnings season, because at least with earnings season, you kind of know what it is that you're going to have happen in some ways, like you know what to expect as the next company that's going to report or whatever it might be. But when we get out of earnings season, it gets a little bit strange. Now, next week, we've got a lot of really interesting earnings reports that are very one-off. And when the market doesn't have these kinds of strong directions, you can get really aggressive moves. So I kind of have to take a look this weekend, but Applied Materials has finally announced its date. I thought it was going to be this Friday, but in fact, it is not. It's on the 18th, according to their website now. But you've got them reporting on Thursday, and a couple of other kind of one-offs will report kind of in a trickle, and they always tend to be very volatile because the traders and the street has time to really think about how they want to position. Applied Materials, though, to me is one of the bigger reports out of all of the guys, because unlike even like a Salesforce, which will, I think, report the following week, Applied Materials is going to tell you kind of the end tail of what all the semiconductor companies have been telling you. And I got to say, there are some real themes, and I'm going to go through that in just a bit on how to think about this marketplace. So this is going to be a little bit of a different call because it's very macro in nature. First, this is today. You know, you're seeing big cap just come straight back, little spots of red here and there. But mostly the market is trying to buy itself, which tells me that people are putting gross on for the end of the year. I wouldn't necessarily try to pretend like it's more than that. Hold on one second. I'm going to stop share for 1 second so I can prepare this one screen. You know, gross export exposure up doesn't necessarily mean that the market is bullish. It just means that people took down and were too much in cash. That's really all it means. And so it can still go very much so either way. But the bias, I think, given what we've seen here, is slightly up for the next month or so with some significant volatility. Let me say it that way. Crude's down 2%, and the fact that the oil companies are starting to not react and the nat gas companies aren't reacting does tell me that people are therefore putting money to work at this point. And then all the other major indices are up. Now, this actually drove me crazy when I saw this. Second quarter earnings have been solid. Energy gets all the credit. And then I read it and I'm like, boy, you guys are really stretching for headlines these days. Because let me tell you, this was not a solid earnings quarter. And that's what I kind of want to talk about a bit today. There were actually still, even though I haven't updated this yet, I probably have another 25 or so, but I'm still seeing about 57% of the companies be fairly good, right? And the rest, it's not this 80% that they're posting. Okay. I don't know what that is precisely. I don't know how they're thinking about it. I don't know if it's they beat the street or what exactly that is, but I'm telling you, only 57% had top line and bottom line growth. And the bottom line growth wasn't so ridiculous that it was like actually negative growth. And quite a lot of the companies is 57%, and even the 5% here, which is understated a little bit. These are companies that had like top line growth, and then in some cases they were like down 20 relative to quarter over quarter. So they made 20% more in revenue, but they sold 20% more to make 20%, or yeah, they sold 20% more in many cases to make 10% less, 5% less. But this number has actually gone up since I've listened to a few. And in those cases, you've got companies that are legitimately flat to slightly up 10% in revenue and making 20% less, 30% less, 40% less. I mean, it is actually not a good quarter. So that kind of confusion makes me a little bonkers. I'm not sure who puts that stuff out. Now, I wanted to go through one company that I just, you know, it is actually technically cheap. I am worried about going into this like gray period that we have. If the market got weak, I would probably want this one long-term in my portfolio forever, because they had an excellent point. This is the numbers. 21% top line growth, revenue growth, 21% earnings per share, super clean, squeaky clean between those two numbers, okay? They just brought it straight down. They made more money. There was nothing weird in operating margins all the way down. Okay, generating tons of cash flow from operations, which just tells you that they're in such a good financial position, and raising full year guidance. Republic Service Group is basically a trash company. But the most interesting and important thing that I think he said that is thematic, is the first like positive thematic that I'll share with you, is the reason they're doing so well is no one wants to take out trash. It's actually as simple as that. As a result, the municipalities who are looking for ways to save money, are looking to be more efficient, are looking to figure out what it is they want to do, they're just outsourcing it to Republic Services. And because of the nature of what they do and how they work, they really can offer a better product right now. So, and this is thematic of a lot of different businesses. In previous episodes, I think maybe even in the March quarter when we were early years trying to figure it out, I continue to remind everyone that there are some businesses where, because the whole millennial, Gen Z, we're doing tech, we're so cool and all that stuff, there's a bunch of businesses that no one wants to do. And they're amazing cash flow, like a clock, they pay you no matter what happens to the economy, it's going to be just fine. Trash is one of them. Water maintenance, that's another, that's American Water Works. A third one that's really boring as they come and just continues to take up more is pool maintenance. And the fourth one that I always like, and that's ticker POOL, with Republic Services, there's also waste management. I haven't listened to that yet, but I'll take a look at that trash as well. And then the last thing that I always say, that if they get clobbered too much, just stick them in the portfolio, is Bugs, Rollins Corp. It's a great, well-managed company. They just changed CEOs because the CEO had been there forever. No shade. I think it's amazing. He's had this amazing career. But like these types of companies, if you're trying to diversify, I know there's a lot of folks that watch this, they're big time day traders and they just want to be like speedy, fast, whatever. That's cool. But whenever these companies, these four companies, Republic Services, Waste Management, American Water Works, and Pool, did I say Pool? Yeah, Pool and Rollins Corp. Whenever they get clobbered too much, there's no reason for it because there really is no one else spraying for bugs right now. There's only maybe one other company that does something in pools, but Pool Corp kind of has a different model than Pentair, to be fair. And then there's some little players. So these are companies you should always take. The other companies that are interesting, but have a little bit more to them, and I probably will do a video on just like long-term holds, set it and forget it, try to diversify out, would be the tower companies. Those are the companies that basically put up towers. Some of them have urban centers, some of them have city locations. And in both cases, the tower companies, as long as we're going to be doing Wi-Fi stuff, as long as there's going to be like stuff going on in the internet, I don't know another way to say it, but as long as we're going to be moving to 5G, the tower companies will always have money. There's no other way to say it. And so, you know, it's very hard to tell from this quarter which way it's going to go. And now let me talk about what I would say were kind of the newer pain points. Some of them, the press has talked a little bit about, I would say, but you know what? We got an actual good look at this quarter. I'm still processing how to think about it from an investment perspective, but I do want to present the good and the bad. I'll do the bad first because these were new. Okay. There were some companies that did not do well. And most of the ones that were truly full of themselves were the ones that blamed FX, but did not actually have any legs to stand on in blaming FX. Like I saw one company, it was down 20% on earnings. And it was like, oh, it's foreign currency related, but only 3% of it was foreign currency. So you can't, I mean, like you're kind of lying at that point. That wasn't your top line. Additionally, in some cases, they blamed FX. But here's the thing. If I don't see top line growth on a constant currency basis, foreign currency isn't your problem, honey. You know, something else is your problem. So, I mean, the ones that blamed FX, and it was true, showed volume growth up like, and positive like revenue growth. That would be like a Ralph Lauren. And then just were like, no, foreign currency, let me show you. That just has to do with the timing between when I actually made item XYZ and when I finally sold it in Europe. So that fair and square, I wasn't as aggressive with Ralph Lauren for that reason. Plus, they are very clear that if China picks back up, it's going to be awesome sauce for them. We still have, by the way, a bunch of retailers to report. So it's going to be interesting to see what they have to say. Still with the supply chain is my issue. Some companies went on and on and on about the supply chain. And some of the worst were companies that had nothing to do with natural gas, like Baxter. You're a medical device company, and you tried to tell me more about nat gas than the nat gas companies did. it is not nat gas is not your problem, honey. Okay. Like, I don't know another way to say it, but the supply chain thing, most companies have it under control in the sense that they're either able to, either you're seeing these things, you're either seeing revenue growth because they're actually able to push through the costs, or alternatively, you're seeing volume backlog show that there is actually demand and that your revenue is being held back by the fact that you can't produce enough product. That would be actually some of your auto companies there. But if you're telling me, you know, it's supply chain and I'm seeing some nonsensicalness on your volumes, I'm not seeing any improvement on revenue, which means you're not pushing costs through, and I'm also just not seeing any kind of backlog, then you're lying. You're lying. I don't know. I mean, listen, I can't get too mad because I would never be qualified to be a CEO. So you got to be as positive as possible. But let's just get a little bit more honest with each other. You know what I mean? Okay. The third thing that I saw that a lot of companies did that is a big BS is actually they reduced R&D to make the quarter. So I saw a couple of companies that were flat top line and then great EPS. And I was like, all right, how'd you do it? Like, how'd you cut those costs? Did you stop paying people and you fired a bunch of people? Did you like figure it out on operating? What was it? And there were more than one companies where all I did was reduce CapEx by like 10, 15%, something really, really aggressive. So I'll be watching you next quarter because honestly, you can't reduce CapEx, especially if you're in healthcare, thinking that that's the right call. So a company that didn't do that, by the way, is Pfizer. And I actually took a little bit more position on Pfizer farther out. No one wants to give Pfizer credit because they think that because COVID, all this stuff. But here's the thing that I've said it since the beginning of the year, the darn thing hasn't moved. And I'm not unwilling to admit I'm wrong on this because Pfizer has a ton of cash. And there are a lot of companies that don't have that benefit right this minute. They can absolutely buy growth or just max out R&D if the street is refusing to give them any credit. They do not need cash. If you look at the income statement, the balance sheet, and the cash flow statement, you can see very clearly what's going on there in the most beautiful way. So they are not reducing R&D, but I'll tell you, there's more than one medical company that made it this quarter by reducing R&D, as well as more than one tech company, which I think is a travesty because there's enough people that are not doing that where it's a little dangerous if you do it for more than one quarter. Now, the fourth thing that I saw that's a little crazy, I saw companies change senior management like they're changing their underpants. I mean, I've never seen anything like it. What, in particular, the one that I think actually was able to clean out the quarter in a very like, let's tie it with a bow, is Henry Schein. I mean, I never saw so many. Like usually the CEO leaves the next quarter, you have another announcement, you know, as he slowly replaces it. But this is like the whole management. It was like, you know, you would have thought that they were calling 1-800 C-suite replacement or something. It was really crazy. So I am seeing massive changes in senior management. More than one call was just introductions of new people that would be on the call for the next following quarter. So that was very strange to me, although in some ways not completely unexpected. The next two things, I'll do the last one, geographic mix. You know, geographic mix is going to be an ongoing theme. And it has been one where people have been like, oh, Asia, so therefore my numbers are, oh, this. The guys that don't do that, I have a lot of respect for because you got to operate how you operate. And you're an international company. So if you didn't think about how you're going to manage geographic mix, then I kind of don't have a lot of love for you on that. But most handle geographic mix pretty well, like especially I was really shocked that a lot of the consumer staples did, and then some of them absolutely did not. And in some cases, some of the staple companies did actually go ahead and eat their costs so that they didn't just basically stick it to all the countries that are really struggling. And that would be a lot of the beverage companies like Coca-Cola and Pepsi both had those kinds of commentaries, but they did come up with ways to manage the mix because Europe's a problem. The euro's just been so aggressive of a fall. And the last thing I saw that's actually kind of relevant is kitchen sinking. I need to do a video just straight up on this term, but I have talked about that this might happen. Now that we're in the third and fourth quarter, we would expect to see it. These are companies that knew that they weren't going to get credit this year. The management team is relatively new, and they're just basically taking every impairment charge they possibly can. They're getting rid of businesses. They're like doing all kinds of flippy flops. And when you read the earnings, and you listen to what they have to say, you're like, yeah, these these financials aren't going to make sense for a while. Emerson is an example of that, although they've been trying to turn themselves for quite a bit of time. But this last quarter is a great example of kitchen sinking. It's very hard to understand what's going on at Emerson right this minute unless you're on the ground. But in general, industrial electronics is actually doing quite well. So that was very interesting to see. So these are the pain points this quarter that will set you up for 2023, which means this next quarter is a very unknown quarter because a lot of companies did one or more of these things. However, there were some really impressive companies that did some things that I would call impressively opportunistic. They are taking advantage in this particular marketplace. And in some cases, it's clear as day in the financials, if not in the earnings report. In other cases, you're like, whoa, you actually have to listen to management. So that's why I am finding all of the news articles nonsensical. That's why I almost don't even want to watch CNBC anymore, because I can just tell that they've never ever talked to management, listened to management, picked up the 10K. It's just too obvious right now whether or not you're doing it. Okay, the first one is a bunch of companies mentioned the fact when they were pushed by the street, hey, you realize I locked in financing already for the next 5 years, right? Like, some of them did not even play. Like AME, Ameritech, they do industrial electronics. She was just pushing them because they actually had a decent quarter. And they're like, look, our debt is at 3.5% long term for a while. I'm pretty sure I can buy whatever I want if I need to right now. So low financing right this minute is a real thing. And more than one company had a great CFO. I mean, this really is the best thing a CFO can do. They went in, they locked in that financing. So if you're doing your deep dive research, just have a look and really, really try to understand the portion of the 10K that tells you how long each tranche is, because more than one company is locked in a very low cost of debt for years to come and will have a strategic competitive advantage to all others as a result of that. The second thing I saw is pushing size against all competitors. And a great example of that is ServiceNow. ServiceNow, their earnings report looked horrible in my opinion, but then I listened to the call and I was like, my bad, you know what I'm saying? Because they were just like, here's our backlog. You see how big this is? Here's this, here's that. What we're doing right now is we're just going to take as much share as we can from these little guys because we can do it. That's how we're going to use capital. That's how we're going to deploy. And I'm hiring, come work with us. I mean, it was a really cool call in a lot of ways, because otherwise, if I hadn't listened to it, only read the report, I wouldn't understand what he was trying to do. But he is 100% trying to get people on the ServiceNow platform so that all of the various pieces that he would have normally had to compete against just decide that it's easier to have a single contract with ServiceNow. And he's not the only one that's doing it. So, and I mean, technically Microsoft is always doing it, as is Google, but it was really interesting because, you know, that's all tech, but it's true in other areas as well, how people are trying to use their size to push and get business. This one I've talked about a lot. It is part of the reason why I am crazy bullish right now, the nat gas and energy complex, and also fertilizer. And this has to do with buying back stock and the dividend yield. I only heard the very baby glimmer of this on this call. These were companies where people were pushing them on their use of capital, and they're like, buying ourselves back is our best use of capital. We're growing at 100% top line. And then because of margin expansion, we're getting like 500, 600 times what we used to, or 500, 600% of earnings falling straight to us because of economies of scale. So we are our best use of capital, 100% hearing it. And then if you layer in the fact that the government is going to increase taxation of stock buybacks for companies that make over $1 billion right now, I think this is what more and more CFOs will be like, why don't we just do that as a slightly higher mix versus dividend issuance? So realize that. And then the last thing that really was impressive, and this is true across all companies, but even more visible among the real estate investment trusts, and that is opportunistic buying and selling of assets. So more than one REIT, I was shocked because I didn't think they had the assets. Like, oh my gosh, I can't even, it escapes me. I'll show them a little bit later, but they showed essentially because they could, and because who is the buyer of some of this real estate is not what you would have normally expected. They are able, so a lot of the office REITs flat out sold whole buildings that were lower yielding, still profitable, but lower yielding, and then took that cash opportunistically to either reconfigure the way that their debt was done, to just shore up capital on the off chance things get awkward, or alternatively, to buy a better yielding asset or to develop a piece of property that they hadn't, that they're just trying to upgrade, and then whatever you will with it. But more than one company was very opportunistic in the buying of selling and assets. In some cases, land was sold for, in other cases, land was bought, and it just depends what the use of proceeds are. So definitely among the REITs, and there I would also look at the lumber companies in particular. Definitely among some of the nat gas companies, because certain fields are richer than other fields. Definitely even the refiners have some very interesting M&A activity. And then it's just a really, but even in tech and healthcare, across the board, when people are talking about the opportunistic aspects of either selling off assets, that probably a little bit more, or buying some new assets, it's been fascinating how they're thinking about it and how this market is giving opportunity. And with that, I know that was a mouthful, but every now and then I got to do a strategic one. I'll go ahead and stop the share. Do you have any questions?
Yeah, very interesting. What did you say about trash? Millennials don't want to do. I thought
they can't hire people. It's really hard to hire trash collectors.
I thought that was a city service.
No, it's outsourced to Republic Services and Waste Management. So municipality by municipality, they've been continuing to win business, and they have economy of scale. So that's true of both trash and water.
Oh, cool. Okay.
Yeah.
So what does a millennial have to do with that? They just take it.
That's the thing. That's part of the reason why they're able to win the business. Because just staffing alone is a real pain for the municipalities. Like, who are you going to find to do your trash? Like, you know what I'm saying? Like, you have to, so they professionally recruit.
The employees of the trash trucks.
Yeah. Trash trucks, they got to divide it into recycled and non-recycled, all that stuff. Every single aspect of trash right now, doesn't even matter what it is. No one wants to do that job for a living. So you do need, so the benefit that they have, above and beyond the fact that they know that business really well. Do you know what I mean? Like, they're really good at trash. I don't know another way to say it. Everything is a business in life, but they're really good at trash collection, trash, everything dealing with trash. But as a result too, they can grow professionals through their ranks versus like if you're a smaller player in trash. In contrast, because they have such economy of scale, they can offer a real career trajectory for those folks. And also they can large scale recruit in a way that's very different from what a local municipality might do, or one of the smaller firms might do.
Cool, gotcha. Okay,
yeah. So it'll just keep, I mean, 20% to 19.6% top line growth, something like that. And then about that on the bottom line. So they work like there's no FX, obviously. They're not outside of the United States. There's no weird supply chain nonsensicalness. It was just straight. Municipalities don't want to do it anymore. They're going to give us the business, so we're getting more contracts.
Gotcha. Okay, yeah. Awesome. Sensionics, which you recommended at $1.
At $1, I know. And I was like, I got rid of the options because I was just a little scared. I still have the stock and I'm not going to let go of it for the long term. But even I was like, this thing is going to go to 3 at a minimum, because that's just where they ran it up to last time. And in fairness, Sensionics, I still have to review the quarter a little bit more. My suspicion is they did fine, but it's really, and I said this to someone initially, they weren't happy with the way I said it, but then later when I explained myself, they were like, okay, fair point. Sensionics has a bunch. The only reason that I care about Sensionics, aside from the fact that I think they have a good product, is they do have a bunch of patents. So there is every reason why someone would want to buy them. And so I've always said since the first day I looked at it, oh, this is a decent takeout candidate. And if they, between then and now, actually kind of fix supply chain and then just ramp up sales, this is great. There's lots of reasons why they might do all 3, to be fair. So, it's going to bounce around. I would say, like, if you hold it, don't be stupid like me and sell your options out. I got a little scared when it went to 2. I'd like right about here. So I sold out some of my options, but now I feel like stupid because I've been saying along it'll probably go to 3.
Okay. Yeah,
definitely don't sell your stock. Hold your stock. Okay. Like, if you've got this, I mean, at $2, who cares?
2.09 is the 200-day moving average.
Okay. So it might just keep doing this little bouncy off the 200-day. Yeah. Well, I'll have more next week on how it did.
Very, very good. It's closing above it.
Okay, super cool. I mean, I that's one of my weekend tasks is absolutely to do a bit more research on exactly what happened this quarter and whether or not I believe them. I think I believe them though. I mean, so let's see.
Yeah, take out Canada, worst case. Okay, thank you.
Yeah. All right, take care. Have a great weekend, guys.